So it sounds like Q3 was broadly constructive for investors. Looking globally then, are we seeing signs of momentum fading?
This isn't just around 7 stocks anymore. This isn't just about Magnificent 7. We're seeing strong returns across all equity markets. Markets being strong, recent all-time highs, but it's covering and masking a number of vulnerabilities, and it's those vulnerabilities which I think will be focused on throughout the rest of this year and into 2026.
Hello and welcome to this month's Market Insight. Today I'm joined with Craig Melling, Director of Investment at Progeny Asset Management. Welcome, Craig. So Q3, it seemed to deliver solid returns across the board. What were the main focuses behind that performance?
Yes, Sarika, Q3 was positive for most major asset classes, but in particular, very strong for equities. We saw trade tensions subside and the euphoria around artificial intelligence continue, not just in the Magnificent 7, but at the broader market as well. The adoption of AI is really boosting this leg of the market. There are some skepticism around the US economy, in particular the labour market, but Q3 was a very, very strong month for equities.
So it sounds like Q3 was broadly constructive for investors. Looking globally then, are we seeing signs of momentum fading?
It's a really interesting question, Sarika, because what we are seeing is we're seeing markets in one hand continuing to post all-time highs, and that's across the board. And we've got the macroeconomic backdrop deteriorating slightly. Global growth is weakening and is projected to be around 2.5% in 2025, the weakest since COVID. In particular, in the US, we've got some real mixed signals where consumption has been good because wealthier households have been spending, but the labour market really is weakening. And in August, we saw some really poor jobs numbers. This is casting doubt around the US economy and potentially raising the risk of a recession sometime between 2026 and 2027.
So retail's holding up thanks to the wealthier consumers, but the jobs data is clearly soft. With GDP growth moderating, it feels like the US is walking a fine line between the resilience and slowdown. So let's have a look at inflation then. So we're finally seeing signs of progress. How's the Fed responding?
Inflation remains on target in the US. I mean, in August, we saw inflation print of around 2.9 to 3.1% for core inflation. But we have seen the first interest rate cut from the US to 4% earlier in the month. And there is continued pressure from the White House for more aggressive cuts, with the market now factoring in potentially 2 more cuts this year and interest rates moving towards 3% by the middle of 2026. It seems a real tightrope at this moment in time. Inflation is really dividing investors, and it's the one thing we are watching very, very closely. And how central banks navigate the inflation backdrop is going to be certainly the key for what happens to the next leg of the markets, in particular in 2026.
So it sounds like inflation's heading in the right direction, but not quite where the policymakers want it to be. With the intervention from the White House, what are we seeing in the US bond markets?
The bond markets are extremely unsettled by this. And again, they're disjointed from the equity markets at this moment in time. One's telling us one thing, one telling us another. And I think as we progress through the end of 2025 and into 2026, we can't keep seeing that disconnect. I think the bond markets will want to see clear policy direction, and they want to see some moderating of inflation, probably in line with those targets.
Looking closer to home then, the UK seems to be doing better than expected this year. What seems to be driving that growth?
Yes, the UK economy has done surprisingly better than most of its international peers. And that's been real strong reprints from the services sector. I think interestingly, what we are looking at is a little bit of uncertainty because we're seeing fragility and volatility in the gilt market. We're seeing that rising business cost from last year's budget. And I think we've also seen a lot more uncertainty about the up-and-coming budget in November as well. Great start thus far for the UK economy. However, I think we'll see a little bit of uncertainty as we move towards that budget at the end of November.
Well, let's turn to Europe. So growth looks quite sluggish there. What's holding things back, and is there any sign of relief?
Europe remains subdued, with GDP growth really focusing and been impacted by the tariffs we've seen from the Trump administration. We've seen 15% blanket tariffs and high sector-specific tariffs. And this has really impacted the exporting economies. I think 2026 and beyond looks more positive because of the infrastructure spends, in particular in Germany, that will power the European economy out of the tariffs. And hopefully we should see strong economic growth.
So Europe's clearly facing some headwinds at the moment. What's the latest in emerging markets?
China's targeting around 5% growth, but it's really uneven at this moment in time in China. We're seeing manufacturing and industrials kind of counteracting each other, whereas we look at India, we are actually seeing strong economic expansion, domestic consumption, and that's leading to a positive picture. I mean, when we come back to China, we may see some government stimulus try and inject a little bit into the economy if it requires it.
Now let's specifically look at growth assets and that performance over Q3. What happened in markets?
Equity markets were the strongest asset class. We saw global stocks rise around 7.5%. The best performing indices was actually the Japanese market, which was up circa 13%. But if we kind of focus back on that long-term trend, those magnificent seven, the AI leaders, again, it was a big focus for investors. They'd led the market by about 8%. But we have seen that broadening out of returns. I think that's been a key theme and something we've discussed a number of times this year. This isn't just around seven stocks anymore. This isn't just about Magnificent Seven. We're seeing strong returns across all equity markets. Europe was a little bit weaker, delivered around 4.5%, but that's because it had to deal with Trump tariffs and in particular some specific tariffs around the pharmaceutical sector. But we are seeing positive returns for markets and lots of markets continuing to deliver and hit new all-time highs.
So then moving on to factor performance, what were the key style trends for Q3 there?
Very, very similar for the rest of the year. Growth stocks are largely outperforming value stocks, in particular in the US. We have seen value stocks do well outside of the US, but larger companies are continuing to outperform smaller companies. There is some green shoots for smaller companies. Last quarter saw a strong market return, not quite as good as those larger peers, but we are starting to see a little bit of a shift in momentum towards small cap stocks. That should almost be helped by lowering of interest rates, in particular in the US. So thus far this year, that trend of large outperforming small and AI-focused stocks being the dominators of returns has come to begin.
So looking ahead then, what could break this trend that we've seen throughout 2025? And how pivotal is that AI-driven productivity?
So the style leadership, which we've seen in 2025 of growth, outperforming value and large outperforming small, all hinges on that AI productivity. The market's hitting all-time highs is really concentrated around that AI adoption, that increase in productivity, and companies being able to deliver the earnings they've almost promised the market. So there are question marks around the vulnerability of equity markets given the lofty valuations. And I think when we look at the Q4 earnings season and what that means and what it tells us around how companies are doing, I think that's going to really determine the next 6 to 9 months in markets. So over the next month or so, it's going to be all eyes on certainly some of the biggest stocks in the world. And can they continue to deliver the earnings they've been promising the market? Makes it really, really interesting time. But actually, historically, when we look back, November and December are very, very good months for equity markets. So I think a Santa Claus rally in December will certainly be welcomed by the market and could actually end 2025 as a very, very strong and post some really good numbers for equity markets. But it's all going to be focused around those company fundamentals now because the valuations are high. So companies need to grow into those earnings.
That's a really interesting point. So do you think we will see a rotation if AI doesn't deliver?
Yeah, and I think what we have been seeing is that broadening out of returns. I think when we look at kind of value and less focus on those AI earnings outside of the US, we've seen strong news flow. We've seen strong share price action, in particular here in the UK. We've seen good returns this year, and not many of our stocks in the UK are actually AI focused or technology focused. So I think we've probably started to see a bit of that broadening out already, but I think equity markets as a whole could come under pressure if we see any of the earnings start to struggle slightly.
So on that note, Craig, how are defensive assets holding up in the current environment?
Continues to be challenging for defensive assets, and we've seen that across the board. US Treasuries have performed a little bit better in Q3. than some of the broader bond markets. But there are continued worries about leadership interference. And so I think there'll be real focus going forward on inflation policy settings, government shutdowns in the US, and just how much the White House is going to impact federal rate decisions. So markets factoring in a couple of cuts for the remainder of the year. But I think it's more of a watching brief right now, in particular on what is the White House going to do and how much is it going to impact the Fed. So bond markets remained fairly subdued.
So UK gilts, they took quite a hit. What's behind that sell-off and how are investors reacting ahead of the budget?
UK gilts suffered sharp losses over the quarter, down around 6%, and that's due to the uncertainty of the up-and-coming budget. One of the latest auctions was actually the weakest participated in for over 2 years. So there's worries around how it's going to fund government spending, but actually what could Rachel Reeves do and what implications could that have in the up-and-coming budget? So gilts remain weak, remain subdued, and I think that's going to be the case until the end of November.
So thanks for that, Craig. So stepping back away from the detail, what's your bigger picture view of being able to navigate through this current environment?
So markets remained buoyed by easing monetary policy and enthusiasm around AI and AI-driven sectors. And that's kind of led the narrative throughout 2025, that Goldilocks scenario of not too hot, not too cold. And that's led to markets being strong, recent all-time highs, but it's covering and masking a number of vulnerabilities. And it's those vulnerabilities which I think will be focused on throughout the rest of this year and into 2026.
So taking that into consideration, what are some of the vulnerabilities we're thinking about?
Yes, a really good point. So we're looking at the labour market weakness in the US, interventions from the US, and actually earnings season. I know we've touched on it, but Q4 earnings season is going to be very, very big for the direction of markets. There's valuations around some of those big stocks, in particular the Magnificent Seven, are really going to be in focus. So for us, we keep with our initial mantra of diversified portfolios, the spread across different regions. This year that's worked. We have seen that broadening out of returns. And I think, we're pretty neutral across all asset classes and geographies right now. And that's due to the little bit of uncertainty we've seen, but ultimately we've seen that broadening out of returns. And that's something we've been positioned for much of 2025 and before that. So the vulnerabilities will be in focus, and it's that macroeconomic backdrop. And actually, how does that look when compared to the new all-time highs we're seeing in markets and earnings season?